The fear is no longer confined to whispers in online chat rooms or dismissed as speculation on obscure message boards. That fear has now climbed all the way to the very top of the United States government. For many years, we have repeatedly warned that a moment would arrive when the individuals who control the printing presses and command the world's most powerful military would finally come to terms with the brutal truth. Silver cannot be printed. We said that once the physical shortage became undeniable, the government would not sit quietly and observe the collapse of the paper markets. They would intervene decisively. They would act to seize control of supply. They would take steps to secure the tangible resources required for national survival. And now, ladies and gentlemen, that moment has arrived. And even the Asian analyst known as John A.G. from Currency Archive is here to confirm it. While everyday investors were distracted by holiday shopping, and while mainstream financial media focused its attention on Bitcoin rallies and soaring tech stocks, the United States Department of Defense was quietly executing one of the most consequential strategic actions ever seen in the history of the metals market. We are now receiving confirmation of a massive, game-changing agreement that was finalized behind closed doors around December 15th, 2025. The contracts have been signed, the money has already been committed, and the message could not be more obvious. The United States is deeply afraid of running out of silver. Here is the reality that paper traders are choosing to ignore. Through the Department of Defense and the Department of Commerce, the U.S. government has entered into a partnership with Korea Zinc to construct a colossal $7.4 billion critical minerals processing facility in Clarksville, Tennessee. This is not a token subsidy. This is not an academic study. This represents the first major non-ferrous metal smelter built on American soil since the 1970s. Take a moment to fully grasp that. For half a century, the United States willingly allowed China and other foreign nations to process its metals. We outsourced the environmental burden and then imported the finished products. But now, in the middle of an accelerating silver squeeze, Uncle Sam is suddenly committing more than $7 billion to bring that processing capacity back home. Why now? Because they know exactly what we know. They know the global supply chain is fracturing, but the most shocking detail of this deal is not even the dollar figure. To understand the level of panic gripping Washington, you have to examine the ownership structure. This is not merely a private company receiving financing. The Pentagon, the United States military itself, is acquiring a 40% equity stake in this project. Let that sink in. The Department of Defense will effectively own nearly half of this facility's output. They are not acting as a customer. They are acting as an owner. This means the silver, zinc, and indium produced at this smelter will not be released onto the open market to suppress prices on the COMEX. It will not be sold to J.P. Morgan to assist in covering short positions. Instead, it will flow directly into the strategic stockpiles of the U.S. military. These metals will be removed from the commercial market before they are even refined. This facility, partially financed by J.P. Morgan, whose role we will examine shortly, is designed to process 1.1 million tons of raw material every single year. It will produce 13 distinct non-ferrous metals, and remarkably, 11 of those 13 are classified as critical minerals by the U.S. Geological Survey. Silver sits at the very top of that list. What we are witnessing is the government effectively nationalizing a portion of the supply chain because they understand that without silver, they cannot manufacture Tomahawk missiles, F-35 fighter jets, or next-generation satellite systems needed to compete with China. They reviewed their stockpiles in December. They saw the export restrictions coming out of China in January. And they panicked. They realized they were exposed. This development validates everything the silver squeeze community has been warning about for the past 5 years. We said silver was strategic. They mocked it as a pet rock. We said industrial demand would overwhelm supply. They said we were delusional. We said the government would be forced to intervene. They insisted the free market would resolve everything. So ask yourself this. Does a $7.4 billion government-backed smelter look like a free market? Of course not. It looks like a desperate attempt to secure resources during a crisis. It looks like resource nationalism, and it proves that at the highest levels of power, silver is no longer viewed as a currency to manipulate, but as a material that must be secured at any cost. So when you examine today's price action on January 5th, 2026, do not analyze it in isolation. Connect the dots. On December 15th, the Pentagon locks in its supply. On January 1st, China enacts export bans. On January 5th, the Shanghai price surges to $82. Do you believe this sequence is accidental? Of course not. Smart money, and in this case, government money, moved first. They secured their insurance policy before the fire started. Now you're watching the flames spread. And this leads us to the most ironic twist in this entire story. The institution enabling this massive transition from paper to physical is none other than our longtime adversary, the architect of the paper suppression system itself. We need to talk about J.P. Morgan. If you believe they are financing this project merely to earn interest, you are missing the bigger picture entirely. They are not doubling down on shorts. They are hedging against their own destruction. They are preparing for the collapse of the paper market they helped create. JP Morgan is not reckless. They are the house, and the house does not wager on a losing outcome if it can avoid it. For 15 years, they have been exposed for spoofing, short manipulation, and control of COMEX futures. But do not confuse ruthlessness with stupidity. They are the most sophisticated commodity traders on Earth. And if the largest silver short in history is now financing the largest physical metals project in 50 years, it is because they know the rules have changed. They are admitting with their capital that the paper era is ending. They see the deficits. They see Chinese solar demand exploding. They see the London fix unraveling. They understand that in a world defined by physical scarcity, paper contracts become lethal liabilities. At $200 silver, their short positions would destroy them. But by financing the smelter, by controlling the flow of metal, they transform themselves from short sellers into gatekeepers. This partnership with Korea Zinc is their escape hatch. While issuing reports telling retail investors to exit silver, while publicly claiming the metal is overvalued at $75, they are privately funding the infrastructure that will control supply for decades. They are reshoring their business model. With London vaults depleted and Chinese refineries inaccessible, they are constructing a fortress in Tennessee. This facility is engineered to process concentrates from Latin America, from Mexico, Peru, and potentially a post-conflict Venezuela, turning raw ore into strategic bars for the U.S. military. JP Morgan understands that Latin America produces silver, but China historically refined it. This plant cuts China out entirely. Latin American mines feed Tennessee. Tennessee feeds the Pentagon. JP Morgan finances every step and positions itself to take a cut of every ounce while securing first access when the squeeze goes vertical. This is insider strategy at its highest level. They tell the world to sell while they buy the factory. They abandon paper games and embrace physical control. And when Shanghai permanently disconnects from COMEX, the only thing that will matter is possession of real metal. JP Morgan intends to dominate that future, so don't rage against them, learn from them, mirror their strategy. Move closer to physical metal. Bypass futures and go to the source. Every ounce you hold is one they wish they controlled. You are front-running the bank that is front-running the world. This shift by Wall Street and the Pentagon exposes a grim reality. While lifeboats are being built in Tennessee, water levels are rising everywhere else. The disconnect is not coming, it is already here. While Americans planned for 2029, China acted in 2026. Now let's examine the scoreboard. Shanghai is screaming the truth. COMEX claims $75. Shanghai just printed 18,120 yuan per kilogram. Convert it properly, and you get $81 to $82 per ounce. Two prices, one asset, same planet, a $7 spread. In high-frequency markets where pennies matter, a $7 gap signals systemic failure. For 50 years, New York and London dictated prices. Today, Shanghai says, we need the metal, and we'll pay more. That spread creates a vacuum. Metal flows east. Western vaults drain. Strategic assets are sold at a discount while China pays a premium. This explains Washington's panic. The smelter is not optional. It is defensive. Without it, America would have no silver by 2027. The government cannot bid openly without exposing dollar weakness, so they chose containment instead. Shanghai's $82 is not speculation. It is desperation. China is de-dollarizing supply chains, paying miners more, hoarding domestic production, and draining global inventory. Paper prices can be printed. Bars cannot. When paper meets physical, physical wins. The spread proves COMEX is broken. If the paper price were real, arbitrage would have closed the gap instantly. Instead, it widens daily. Western systems are clogged with derivatives. Eastern markets run on delivery. The Tennessee smelter is America's attempt to build a dam, but dams take time. Until 2029, the drain accelerates. Panic grows. Prices must rise or the metal disappears. This is the trap. Suppress prices and lose the metal. Raise prices and expose inflation. Control is gone. Shanghai has forced their hand, and that is why Tennessee matters. The U.S. must intercept Latin American supply before Beijing locks it up forever. This is not theory. This is happening now. This operation is far more significant than a single industrial facility. It represents a geopolitical anchor point. It is a deliberate attempt to lock down and secure the supply arteries of the entire Western Hemisphere. We need to examine this reshoring strategy carefully. We need to understand why insiders are saying this project is bigger than Venezuela itself. And when we say bigger than Venezuela, this is not exaggeration or dramatic flair. We are talking about a structural overhaul of the global energy, technology, and defense supply network. For the past 3 decades, Western nations have played an extremely dangerous game. We willingly allowed the most critical part of the supply chain, the midstream processing, the smelting and refining, to migrate almost entirely into Asia. We were perfectly comfortable extracting ore from the ground in places like Nevada, Peru, or Mexico, loading it onto ships bound for China, letting Chinese facilities refine it, and then purchasing the finished metal back at a premium. It was cheaper, it was efficient, and for a long time it worked, so long as the world remained stable and cooperative. But the world is no longer stable. The global order is splintering, and in a fractured world, one rule becomes absolute. If you do not control the smelter, then you do not control the metal. The Pentagon looked at the global map and confronted a terrifying reality. North America processes less than 10% of the world's critical minerals. China processes somewhere between 80 and 90%. If a war began tomorrow, or if trade restrictions like the export bans introduced on January 1st continue to escalate, it would not matter how much silver ore exists beneath the soil of Mexico or Peru. If that rock cannot be transformed into high-purity, military-grade bullion, then it is effectively useless. It is dirt, and dirt does not power radar systems, satellites, or hypersonic missile guidance assemblies. This $7.4 billion facility exists as the answer to that nightmare scenario. It is engineered to function as a fortress for critical minerals. It is designed to process 1.1 million tons of raw material every year without interruption. And while the headlines label it a zinc smelter, that description is intentionally misleading. Zinc is merely the transport medium. The true value lies in what is embedded within that ore. This single facility will produce 13 distinct non-ferrous metals, and 11 of those are officially designated as critical by the U.S. Geological Survey. We are talking about indium, a metal vital to touch screens and solar panel technology. We are talking about gallium and germanium, foundational elements for semiconductors, advanced optics, and night vision equipment. And yes, we are talking about silver. The strategic concept at work here is known in military planning as interdiction. Today, most silver and zinc concentrates extracted from the rich mines of Peru, Chile, Mexico, and Bolivia are loaded onto cargo vessels and sent across the Pacific to Chinese refineries. China refines the raw material, retains the strategic byproducts, and sells the remaining metal back to the West. The Tennessee smelter is designed to intercept that flow. By constructing a world-class processing facility in the American South, closer to the source, the United States is attempting to create a gravitational pull stronger than China, US. The goal is to convince miners in Lima and La Paz to ship their concentrates north to New Orleans and up the Mississippi River rather than west to Shanghai. This is an attempt to sever the supply artery feeding the Chinese industrial machine. This is where Venezuela becomes central to the story. Venezuela sits atop enormous untapped mineral wealth, not only oil, but gold, iron, and potentially vast silver deposits that remain largely undeveloped. If reports of oil for yuan, or yuan-based trade arrangements, are accurate, then China is actively working to secure Venezuela's resources. The United States cannot permit a Chinese resource colony to take root in its own hemisphere. This smelter provides a commercial counterweapon. It allows the U.S. to approach Latin American nations and say, "We will refine your metal here. We will finance your extraction. We will integrate you into a fortress North America supply chain." This is the Monroe Doctrine reborn, not enforced with warships, but with blast furnaces and balance sheets. The construction timeline reveals everything. Site preparation begins in 2026. Construction ramps up in 2027. Full operations are expected by 2029. This schedule tells us exactly when Pentagon planners believe the resource conflict will reach its peak. They know the next 3 years represent a window of extreme vulnerability. They are exposed. And yet they are wagering $7 billion that by the end of the decade, the world will be divided into two hardened economic blocks, East and West. In that future, the only metal you truly own is the metal you physically possess. This is precisely why J.P. Morgan is involved. They are not merely providing financing. They are acting as the logistical architect. They will negotiate contracts with mines in Peru. They will manage price hedging. They are positioning themselves as the toll booth operator for the Western Hemisphere's entire metal flow. In effect, they are privatizing the strategic stockpile. And ask yourself this: do you invest $7 billion into a facility designed to produce something you believe is becoming worthless? Of course not. You make that investment because you believe the product is becoming priceless, because you understand that access to physical metal will be one of the defining competitive advantages of the 21st century. This smelter represents the death of the globalist just-in-time trade model. It marks the transition to just-in-case security. It is an admission that free markets failed to protect national security, and now the state is stepping in forcefully. For silver investors, this is the most bullish signal imaginable. When the most powerful military on Earth and the most powerful bank on Earth collaborate to hoard your asset, the correct response is not to sell, it is to buy. You are holding an instrument of national security, but one final component remains unaddressed: We have covered the geopolitical conflict. We have covered the industrial restructuring. What we have not yet addressed is what this does to price discovery itself. If the Pentagon is acquiring physical metal, China is acquiring physical metal, and smelters are being constructed specifically to lock physical metal away, what happens to the paper contracts traded daily on COMEX? What happens to the billions of ounces of synthetic silver that exist only on screens? If physical metal is sequestered in military vaults and sovereign reserves, the paper market loses its foundation. It becomes a hollow shell, and hollow systems eventually collapse. This deal confirms the death of paper silver. The $7.4 billion Clarksville project is the death certificate of the futures market. Think logically. If paper contracts truly functioned as advertised, if they were equivalent to physical metal, why would the Department of Defense spend billions building a refinery? Why not simply purchase futures and take delivery when needed? Why seize 40% ownership of production? The answer is obvious. They know the paper market is an illusion. They know that in a real crisis, you cannot melt down a futures contract. You cannot install a digital promise into a weapon system. You need element 47 in physical form. The futures market operates on fractional reserves. For every physical ounce in COMEX vaults, hundreds of paper claims exist. This works only as long as nobody demands delivery. But what happens when the Pentagon demands delivery? What happens when China demands delivery? What happens when J.P. Morgan, the architect of the paper system, abandons it and begins hoarding bars from Tennessee? The music stops. The chairs vanish. This smelter signals that institutional players are cashing out of the casino. They are converting paper winnings into hard assets before the structure collapses. Retail investors holding unallocated accounts or non-deliverable ETFs are being left behind, funding the transition while receiving nothing in return. This explains the widening Shanghai-New York spread. Shanghai trades physical reality. New York trades paper ghosts. As Latin American supply is redirected to Tennessee, COMEX will become increasingly irrelevant, a museum of price discovery while the real market operates behind closed doors. So when you ask whether paper silver is fake, the answer is no longer theoretical. The Pentagon's $7 billion check is your proof. Physical is king. And if you hold paper promises, you are effectively subsidizing the bank's escape while being left with nothing. This is the great decoupling. Paper prices may go to zero or infinity. It will not matter. The metal will be elsewhere. So what remains for the individual investor? You cannot build a smelter. You cannot purchase a Peruvian mine. But you can align yourself with the same trade the Pentagon is making. Follow their lead. Ignore the Federal Reserve's reassurances. Ignore Treasury statements. Ignore analyst dismissals. Watch actions, not words. The U.S. government is writing a $7.4 billion check for the metal they say is abundant. That is the ultimate tell. If silver were plentiful, the Pentagon would buy it on the open market. Instead, they are stockpiling like preppers before a storm. And if the most powerful military on earth is preparing for shortage, selling your silver would be madness. You should be accumulating, securing your own supply chain. And finally, consider Korea Zinc. This is not a random choice. Korea Zinc is the global benchmark for refining excellence, and a supplier to elite private mints, including Scottsdale Mint. When you buy silver sourced from that same supply chain, you are holding military-grade material, the same molecules the Pentagon is racing to secure. As supply tightens, premiums on high-purity metal will explode. Only mints tied into strategic refiners will have product. Everyone else will wait behind missile programs. This is the message for January 5th, 2026. The window is closing. The government has entered the market as a whale. When governments buy, price sensitivity disappears. They print whatever is required. The Shanghai breakout was the warning shot. The smelter is the declaration of war. Return on capital no longer matters. Return of capital does. The paper system is burning. The only safe harbor is physical silver. Do not panic on volatility. Remember who is buying. If they are not selling, neither should you. Be patient. Hold tight. The shortage is real. The panic is real. The squeeze is inevitable. This is John A.G. from Currency Archive. The cards are on the table. Now it's your move. Hold the line, subscribe and share. Chat.